Testing. Hope everyone is doing well. Interesting day overall in the Emini. I'm going to go ahead and ask questions. I'm going to review them at the end of this review though, but I will take a look at them afterwards. So on the monthly chart, as we all know, the end of the month was last Friday. We had a very strong rally into the close, and February was a bear bar. The market reversed down, then quickly reversed up, and now we have a bull bar. And to me, I see this pretty similar to the daily chart. And here we had a strong rally and a little bit of a two-legged pullback, and we may get if the bulls are lucky, we may test the August 31st high, and the bulls will get leg one, pull back, leg two. I don't think we're going to go all the way up to there. You know, the bulls ultimately, they want something like that. But to me, when I look at the monthly chart, look to the left, tight trading range, I expect something to be disappointing right here. Weekly chart, pretty much a triangle. And 4,000 is the apex of the triangle. We had a strong reversal up over the past few days or past few weeks. probably going to get to the February 2nd high. The bulls ultimately want to get to the August 19th high. And, one important thing to point out, it's easier to point it out on the daily chart, is 4,000 is the apex of a round number. Let me do it like this. And you have to wonder, 4,000 has been the midpoint for a long time. I mean, ever since over here, early 2021, 4,000 has been important. We have the all-time high, and Al has talked a lot about this. We have the all-time high in January of 22 and 4,000 right here. Typically, when the market goes sideways for several bars, it is often the midpoint of a measured move retracement up or down. So we have an obvious high. You have to wonder if the market is going to try at some point and sell off to 3,100. Now, when would that happen? Who knows? This could be a leg one. We could go sideways for a long time, rally up to here, and then get a leg two. So if you think about it, we know where leg one is. It's the high of January 22nd to the low of October. So the next question is, let's say we think 31,000 is an obvious magnet. Well, one has to wonder if we pull back to the August high. So if we sell off from here to here as the first leg, and then we get a pullback to the August 19th high, even if we go a little bit above it, a measured move, leg one, leg two, would take you all the way down to 3,100. So it's possible that we rally, fail, and then sell off to here. Here being 3,100. The daily chart, we've had just a really, really strong rally over the past few days. And I did not think today, I thought today would be a bear bar and we would get profit taking from Friday's buy climax. And, as far as right now, we're probably going to go sideways fairly soon. This is pretty tight. So the first reversal down will probably fail. But either way, the bulls want a measured move up. Measured move from the March 13th high to the May 22nd. What do I think is going to happen over the next couple of days? Probably sideways and partial in bears. Bulls taking partial profits, maybe aggressive bears selling. But right now, this looks pretty good for the bulls. And I want to say one other thing about the weekly chart. The bulls have a really good bull bar. Small tail, big body, closing above the March 13th high. It'll be interesting to see this week, can the bulls keep this gap open? Will the bulls be able to prevent the market from falling below the March 13th bar right here? And can they keep this bar as a bull bar? So this week is pretty important. We're also at an obvious trend line on the daily chart, which is this line right here. So it's possible this is a buy vacuum test of the trend line, but this has enough energy and momentum that it's probably going to go sideways for some time. 5-minute chart. We knew coming into the day that yesterday had a lot of climactic behavior. Very strong small pullback trend, sold off for a little bit, and basically went up for a measured move. So consecutive buy climaxes going into the close of Friday and the end of the month. Therefore, we knew 75% chance the market was going to go sideways for at least 2 hours today, and beginning before the end of the second hour. 50% chance the market would have an opening rally and get trend continuation lasting for maybe an hour, and then the market going sideways for 2 hours. But either way, there was a 75% chance of sideways for at least 2 hours, and it typically begins before the end of the second hour. So what that means is by bar 24, there's a 75% chance we were going to get at least 2 hours of trading range trading starting by bar 24. And that is because of consecutive buy climaxes today. Bar one, let me do one thing here. I I've got to stop sharing my screen really quick. I'm going to add a bar counter. For whatever reason, it turns off whenever I adjust the time frame. Okay, there we go. So bar one, bull bar closing on its high, pretty big trend bar. Is it always in long? It might be, but in general, for always in, you want to see consecutive trend bars up or down. And this is pretty similar to yesterday or Friday. Friday, we had a big bull bar, but it was gapping up above the prior bar, above the prior highs. And then we got followed through on the next few bars. Do you really think that today's going to do the same? Probably not. So for me, I want to see consecutive bull bars. Bar two, consecutive bull bars, good for the bulls. Is it enough for the market to be always in long? It is. But if you were listening to Al in the trading room this morning, you would hear him talk about how if bar three is a bear bar, bulls get out and maybe aggressive bears sell. And the reason they would do that is it's a possible wedge 73, 78, and bar two. So three pushes up. And if it is if it's three pushes up, it might be a leg in a trading range and it may test the low of bar one. Three, it's a bear bar, close on low, probably buyers below, okay to exit shorts below the bar. And you can see what happened. Three never triggered and the market went straight up. So bar four trapped the bears into selling what could be a bad sell. Some bears would front run, betting that this bar would trigger, and then it immediately went up. So traders obviously buying on the way up of four. Four, a little bit of a surprise bar, but it might be a trap. It may lead to a small second leg up and then find sellers. So again, traders are buying, but look at bar two and then look at three. Bulls bought the close of one, and when the market went above bar 78, traders immediately sold. Bar four, we have a strong bull bar. What do you think the follow through is going to look like? To me, probably bad follow through. Five, two legs up, leg one ending at three, and then leg two ending below five. It's a second entry short. You can call it a failed breakout of a wedge. Strong enough bars, one, two, and four, probably more sideways than straight down. However, the bulls that are trading always in long, or that are long for any reason, it is reasonable to exit longs below bar five. Reason for that is the stop for the bulls is probably all the way down here. And if the market's in a trading range, we may sell off all the way down to here and find buyers. Thank you for that. We'll deal with the logo for another day. Bar five, bear bar, reasonable to exit shorts, reasonable to exit longs, aggressive bears will sell. Bar six, that it's follow through for the bears, but it's not that great. And then seven is six is a high one by, seven's a bull bar, but it's possible second leg from four. Four is a strong enough breakout for at least a small second leg. Well, we have a second leg on seven, which is the current bar. And look at the stop entry above it, bar six. Six is a bear bar. So if you think about it, we had bar three, stop entry above three, which is a bear bar. It's in essence a high one buy. And then we had another high one buy above six, and it's a bear bar. So you have to wonder, limit order traders are probably going to make money. Now the bears, they want a small pullback trend. They have an open gap, the three high and the six low. They're going to try and probably form another open gap if this is going to be a bull trend from the open in a small pullback bull trend. But you can see the bears made money. Bears sold the six high, sold more above seven, and the market went below the six high on eight. So bears are making money. And because of yesterday, you have to assume the bulls are probably going to make money as well. 9 is another breakout pullback. So we had a breakout pullback, a new high, and then a pullback, trying to get a new high and a pullback. It's basically a wedge top. 1, 2, and 3. It's a bull bar closing on its high. But when you look at the rally and compare it to yesterday, where are the consecutive bull bars today? 1 and 2, good for the bulls. But everything above bar 78, this bar right here, is getting bad follow through after every bull bar. And another thing Al mentioned in the webinar is the bulls are winning in terms of price. The market is going up, but time is another variable. We have 2 bull bars and then a bear bar. And then we have another bull bar and 2 bear bars, and then a bull bar and then a bear bar. So the bulls and bears are alternating in terms of strength. That is a sign of weakness for the bulls, and it increases the odds of the market being more neutral. 10 is a breakout above 7, decent bull bar. It's possible we're getting a measuring gap. 11 and 12 are going to be important bars. That will be the close of the 60-minute chart. The bulls have a breakout above 7. Good. Let's see what the follow through looks like. And then 11 is an even bigger bull bar. So, possible measuring gap, the 11 low and the 10 and the 9 high. But one more bar for the 60-minute chart to close, and it's a doji. So we have a bull bar closing on its high. 12, high one buy, probably sellers above. Do it like this, make it easier to see the bars. So 12, probably sellers above, and there were on 13. Now 13 is a doji bar, and it's a bad short below the bar, but consecutive buy climaxes, traders will probably use the bar to take profits. And then we have a very big give up bar on 14. When you look at 14, ask yourself, who's going to buy above 15? If 15 is a bull bar, there's probably sellers above. Now, what traders do not know is the market may have to rally all the way up here before traders come in. But 14 is enough for traders to exit. If I'm a bull and I did not get out below 13, I have to exit on the close of 14. Give me just 1 second. 15, follow through. So now the bears have 3 consecutive bear bars. It was reasonable to sell the 5 low. You can see traders sold below 5. They sold more higher, and they're making money. To me, this is a big enough bar that we have probably started 2 hours of sideways trading. So to me, it's sell the close 14, sell the close 15, sell above anything, betting on a second leg down. And then 16 is another big bear bar. So we have a breakout and a pullback, and then another big breakout bar. We're below the moving average, good for the bulls. We're back to the March high, good for the bulls. Probably going to try to get down to the open of the month and open of the week, and the open of the day, which is bar 1. Now, with 4 consecutive bear bars, probably sellers above. But when you look at this chart, ask yourself, we have a very strong trend from the 54 low to the 12 high. In other words, yesterday's 54 to today's 12. We're getting a sell-off. So we have big up and big down. That means big confusion, probably going sideways. 17, now we have another bear close. Is it sell to close? It's been sell to close since 4, but we have 1, 2, 3, 4 consecutive bear bars. And you have to think about it. Whenever you start to get 5, 6 consecutive bars in a row, 6 consecutive bull bars, 6 consecutive trend bars, that the probability gets less for a 7th bar and an 8th bar and a 9th bar. We all know that. We have a micro channel here. And this sell-off looks fairly climactic. We have a really big bar and then a small bar. A big bar and a smaller body. It's good. And it's the odds are you're going to get a second leg down. But the March high, it was reasonable to buy the March high as the market was selling off. It was reasonable to buy the 6 low as the market was selling off. Typically, the market, when it forms a wedge, 1, 2, 3, or 1, 2, 3, I would see this as nested, and I would see the 6 low as the probable third leg. You could even buy, the point is, you could buy the 6 low, and the traders that buy the 6 low during 16 and buy more lower, let's say above a bull bar, will probably make money. And I just want to point that out real quick. So if you buy the 6 low, you buy more above a bull bar, maybe here, maybe here. Look what happened. Break even was somewhere in here. And obviously, the market pulls back and it retested the 6 low. So that is typical in a trading range. For most traders, I would take partial profits down here. You're getting back to the zone where bears originally got trapped. 18, another bear close, but this is basically a V top. We have a rally, even though it's a wedge top, and it is, there's a bull breakout, trend line break, bull breakout, a smaller trend line break on a smaller time frame, and then another bull breakout. It's basically a V top, and that will increase the chances that the market's going to have a deep pullback. So big up, big down, big confusion, probably sideways, but always in short, and you can probably scale in higher. Now, 19 is a very important bar, and it's a subtle bar. It's a doji. We have a doji in a sell to close market. Go back to the video course and think about what Al talks about with dojis in a sell to close market. Whenever you get a doji, it's a trading range bar. And when I see a doji, it's similar to bar 8. If I'm selling closes, for me, I sold here and I was short in here. But my problem is I know sell to close markets are brief. I don't want to have a deep pullback. When I see this, it's kind of like if you ever played, roulette at a casino, how many times is it going to land on red? The more and more, bear bars you get, there's eventually going to be a bull bar. And when you see this bar, the odds become much significantly higher. Any downside breakout is going to get pulled back to this bar. So you see a bear close with the tail, see a follow through bar, and then look what happened. On the very next bar, we went one bar below, two, and immediately went back to this bar. Now, I mentioned it's sell to close. For bears, I would get out, a couple points above this bar because the odds are you're going to get back to here. And it's a trading range. Trading ranges get fairly deep pullbacks. Fairly deep pullbacks could be the 6 low. So for me, it's always in short, and I see 22. 22 is a bull reversal bar. And part of the way you can you judge whether or not to get out of bars, whether or not to get out of a trade is there going to be a second leg against you? So when I see 22 and I'm short or I'm flat, I'm looking to sell, I look at 22 and I think 22 is big enough to have a second leg. What that means is even if 23 is a bear bar, which it is, who's going to sell below 23? 23 is a low one short, but it's following a big bull bar. And because of that, everybody's probably going to buy the low of this bar. High one buys and low one shorts are great when the breakouts are strong and in the first leg. So let's find a good example. We had one yesterday. We have a strong breakout, pull back to 24, and we have a bull bar. It's not, even though it's climactic after this small pullback trend, 25 is not a terrible high one buy because we have a strong breakout, probably going to get a second leg. Bar 3, it's basically a high one buy. It's not the world's best high one buy because it's a big bear bar following a climactic day on Friday, but it is still a high one buy. 67, strong breakout, breaking above all these bars to the left. It's a breakout, expect a second leg. 68, 69, it's both a high one buy. Now, on a smaller time frame, we went above 68 and down. So technically the high one buy failed, went lower, and then the market formed a micro double bottom, which would be a second entry. But regardless, it's basically just one high one and the market went higher. So when I see this, a low one short at support, the one low, and what's probably going to be a trading range day, I get very nervous as a bull. Therefore, I get nervous as a bear. If I'm nervous to sell as a bear or to be short as a bear, I get very excited as a bull to buy. So if I'm flat, what am I doing on the 23 close or the 23 low? I'm buying. Why am I buying? I'm buying because the market is probably going to rally at least a little bit higher. 24 inside bar, 25 a bull bar. So there's a second leg. Now, because of this sell off, I'm expecting a second leg down. When I see this rally, I'm disappointed and I'm thinking, gee, that's a deep enough pullback. There's probably buyers below. It's a micro channel since 22. What about selling the close of 23? Well, the reality is you probably can sell the close at 23 and scaling higher. But the problem with selling the close of 25, you can sell the close of 25 and scaling higher. But the problem is it's a micro channel, first reversal down, it's probably going to fail. 26, a doji. It's a doji, it's a bear bar, it's technically two legs up. Leg one, 22, pull back 24, leg two, 26. But I don't want to sell below a doji bar in a micro channel. If anything, there's probably buyers below. So the way you think about that is 22 is a big bull bar. And it's a big bull bar because on a 1 minute chart, it's probably two or three or four consecutive bull closes. So what about the rally from 22 to 26? Well, it's a rally. So on what? A 15-minute chart or some other time frame, it's one big bull bar. So this one bar 22 is in essence one bar from 21 to 26. What do I think? So what does that mean? That means that there's basically a low one short that's going to form if this bar triggers and probably fail and go higher. So there's probably buyers below. Now, another thing I'm thinking about is it was reasonable to sell the close of 21. If it's reasonable to sell the close of 21, you will have bears sell the close, use a really wide stop, and sell more below a bear bar. Is this the bear bar they sell more below? No, there's probably buyers below. It's probably going to get a second leg. And we have a bull bar and an inside bar. And now we're breaking above a tight trading range. A little bit of a surprise, may get a second leg up, but we're getting close to the March high, and this might be the area where bears are going to come in. Will bears sell the close of 30, the current bar? Some might. The problem with selling the close of 30, though, is we're getting a lot of bull bars and we don't know where the top of the range is. We know the odds are the market's in a trading range. In other words, this is probably not going to be a bear flag that leads from a top 30 and 18 high, breaks below 20, and leads to a measured move down. We know the reality is, even if we sell off, we're probably going to find buyers somewhere down here. 31, doji, closed above the moving average, good for the bulls, and it's a bull bar, so it's follow through from the breakout on 30. You can argue it's basically a small pullback trend, but it's a small pullback bull trend within a trading range. That will increase the probability of more sideways. But the bears need to make the market go sideways in order to reverse the trend. So we're collecting a lot of bull bars, and that's good for the bulls. But I suspect we will need higher low. The bears that sold down here are likely waiting to sell higher. They may be disappointed enough that any pullback, they will look to get out break even. But the one thing you have to think about with trading is you never know. Plenty of you people, plenty of you guys have heard Al talk about this in the trading room, but you never know how many traders are just waiting to sell. In other words, you never know how many institutions are on the sidelines, how many dollars are just waiting to sell at some price level. It's kind of like down here. The market's selling off, and then all of a sudden, buyers come in out of nowhere. The market starts to rally, and for whatever reason, there's going to be a resistance level up here. But you had institutions selling aggressively at this price level. So somewhere up here, there's probably going to be sellers. Somewhere down here, there's probably going to be buyers. Bull breakout 43 might be a measuring gap. We have an open gap, the 25 high, 32 low right here. So you have to wonder, we already have this gap. And you have to wonder if this is going to lead to another measuring gap, which right now it's open. and then we get a big bear bar. So the bears were able to close the gap. Good for the bears, but tight bull channel, probably more sideways than straight down. 35, big bear bar. So a little bit of a surprise, may get a small second leg down. And I suspect there's probably sellers above 35 and 36 if it's a bull bar, but it's still a small pullback trend, tight bull channel, first reversal down, probably will fail. And then we get a doji, probably sellers above, and you can see it's a small pullback. I know it's getting hard to see this chart. I want to try and make the bars bigger. And you can see we have a doji, so we went down on 35, up on 36, down on 37, and up. So it's two-legged pullback. Some bulls will buy, betting on a new high, but type trading range, basically a triangle, 32, 37, or 32, 35, and 37. Three pushes, 1, 2, 3, 1, 2, and 3. Might be a final flag, so any upside breakout may fail, and instead we got a downside breakout. 39 is a bear bar, and it's a breakout below 35. Is it a sell to close bar? It might be, but I think the bears need one more bar at a minimum, and it really needs to look like 37, 39, or else there's probably buyers. And you can see instead it was a trap. So what happened? You had some bulls, they bought above 37, and they bought more at the 37 low. And right now on 40, those bulls are deciding what to do. Bulls buy, they buy more below 37. Some will get out, just break even on the entire trade, and they will abandon the idea of making a profit. Other bulls will say, yeah, it's a trading range. We're probably going to retest the 37 high. And you can see, look what happened. It retested the 37 high and immediately turned down. So traders, again, traders will buy high in a leg as long as they think it's still possibly a bull trend. When they believe it's in a trading range, they will begin to sell out of longs. Outside down, 41, possible breakout below a bear flag, or excuse me, possible bear breakout below a bull flag, 1, 2, 3, so 3 pushes down, we're breaking below it. So we might get a measured move down from here to here, which takes us back to the open of the week. So if I'm a bull, I think it's reasonable to exit below 40 or the 41 low. Break follow through on 42 consecutive bear bars, but you're getting in the zone where the market could fail and lead to a higher low. We had the low, we had the high. 50% pullback is somewhere around this purple line right here. Big sell-off bar and a rally. So what happened here? Well, remember what I said about those bears on 21? If I sold the close of 21, let's say I sell the close of 21. See this bar, and I'm thinking, okay, I'm going to sell the close. I use a wide stop and I'll scale in. And I'm thinking, wow, that is not what I wanted to see if I sold the close. But it's either a trading range or a bear trend. I'll just scale in. Well, some traders, they will scale in one and then scale in again, scale in again. But the problem with that is you can use up all of your position and sell too low in the range. So a lot of traders, they sell and they wait for a stop entry. No reason to sell yet, no reason to sell, and then boom. 3 pushes down. We tried to break to the upside. So we had a bull flag to 40. We tried to get a bull break out of the bull flag, and then we're failing. So some bears, they sell below 21. They sell more below 40, 41, this bear bar. And they're so disappointed, they just say, you know what? I'm just going to try and get out of break even on the whole trade. So I'll sell this close and I'll get out right here. You have bears that say, yeah, I know there's trapped bears here. So I'm going to short and I'll take a quick scalp back at this midpoint. And then you can see what happened. The market basically tested the midpoint right there and turned up. So trapped bears are likely buying back shorts in here. And that's what happened on 44. 44, micro double bottom with 43, big bull bar on 44, so big risk, increases the probability more sideways, and then a small entry bar on 45. It's a bull bar, good for the bulls, but you have to ask yourself, where is the follow through for the bulls that bought above 44? Why is 45 a weak bar? it's a weak bar because it's a trading range. Look what the bulls did on 40. Remember what I said about the bears? Excuse me, the bulls that buy above 37 here, and they buy more below a bear bar, like 37. They exit during 41. Well, what do you think the bulls did? There's some bulls that bought above 40, and they didn't get out below 40 or below 41. And what do they do? A lot of them bought more somewhere down here, maybe the open of the week, or maybe a measured move down of 40 down here. They buy more, and what did they do? Look to the right. They were so disappointed by the sell off, they used this high, the high of 45, to get out back at the 40 high. Whenever you have stop entries that trigger and then the market goes against the stop entry and then the market rallies back to it and reverses, you're in a trading range. Look at 26. You sell below 26 thinking low one short, bear trend, I'll sell and scale in. It's a doji. It's a bad sell, but let's say you took it. Or maybe you sold below 27 and you sell more higher. Look what happened on 43. It retested 27. So if you're a bear and you sell here and you sell more higher, are you really that eager about the pullback? Of course not. It's the same thing here. If you bought anywhere in here and you buy more lower, like down here, what are you going to do on this bounce? You're going to get out. Follow through 46, testing the March high, and then bad follow through 47. Where are the strong bull bars? So we have a big sell off and a big rally. You had bulls that bought, they bought more lower. They're probably going to exit. And then we have a give up bar on 48. 48 is a big bear bar, but we're in a trading range. And you never know. Remember what I said down here and up here? You never know how many dollars are on the sidelines waiting to buy aggressively. Here, you never know how many dollars are on the sidelines waiting to sell aggressively. 48, surprise bar, probably going to lead to a second leg, but we're in a trading range. The second leg, we could easily go above bar 48 before we get the second leg down. So if you're selling the close of 48, it's not really that simple of a trade. And if you do, you really need to be able to scale in higher. Otherwise, it's better to wait for a clear breakout. Wait for a strong breakout below here or strong breakout above here and wait for follow through. 49, it's bad follow through, but it's bull bar. Why is there a tail? Some bulls bought 47 low, bought more lower, and they look to get out back at the 47 low. Others buy this low, they buy more lower, and they look to get out break even. To me, the size of 48 is strong enough to make me think that the market is going to have a second leg down. 50, bull bar, but there's a tail. The market went up basically two legs. One. So it went down and then went up, pulled back, and then went up again and pulled back. So it's basically two legs up. And then 51, a bear bar. So for the bulls, most bulls, if you're betting, bulls are long, betting on a second leg from here. The problem with being long here is you need to stop really below further, I would say probably somewhere down here, maybe 41.30, because the reality is even if we fall below 43, we're probably going to find buyers. So when I look at the 43 low, I see it as a skunk stop because there's too much risk of a sell-off, pullback, and a second leg down and buyers down here. And that's because the market's in a trading range. 52, doji, testing the 43 low. And this is very common. We have a low at 43 of 33.5, and we have a low of 52 at 33.5. So we have two perfect lows, 43 and 52. And they're bear bars. They're dojis. They're not strong. They're not strong buy signal bars. You really think that the market's not going to fall one tick below 43? To me, 52, this current bar may be a trap. It may trigger the buy and go a few points, maybe a few ticks, maybe a few points below 43, and then reverse up. And then we didn't trigger, but we went below 43 and turned up. And then look what happened. we got a buy signal on 54. 54 doesn't look like a great buy signal, but we've had several pushes down. We had a push down on 48 and a second leg to 54, or we had a breakout and then two legs down. And it's a second entry buy, or you can call it two legs down from 43 and then 54. And it's basically a higher low major trend reversal. So if you're a bear and you sold anywhere in here and you did not take profits here, what are you likely doing here? You're probably taking profits. So for always in traders, I would exit shorts above 54. Too much risk of the market going higher. Now, because of 54, the size of 54, the market may have a reasonable pullback. 55, bear bar, it's a doji. It's basically a low one short, probably buyers below 55, and the market's going higher. Kind of like over here, 22, we have a bull bar, and then 23 is a doji. It's a bad stop entry short. 55 is a bad stop entry short. And then 56, we tried to break to the upside, failed. And then we tried to break to the upside again and failed. But the market's trending. We're getting a low and then an equal low, and then a higher low, and an equal higher low. And we're getting highs above the high of every bar. Now we are not getting closes above the high of every bar, so that is a strike against the bulls. But we're starting to form a tight channel, and you have to wonder if traders are going to get squeezed here. Some bears, they sold the 53 high. If they didn't get out during 55, they got trapped on the 56 low and 57 low. And the same thing on 58. So you have bears selling, trying to get out break even. Bears that sold the 53 high. And then 59 is a bull bar. To me, if I'm short for any reason in here and I start to see a micro channel, 4 bars, 5 bars, 6 bars, and we finally get a bull bar closing on its high, there is no way I'm going to hold short above that bar. And the reason for that is on a higher time frame, the 54 low to the 59 high is basically a reversal bar. It's this on a higher time frame. And I don't want to sell above that bar. If anything, I want to buy. 60, doji. It's a trend bar. It's basically a doji bar, but it's the minimum follow through for the bulls. We failed to close above the 50 high, so that's a sign of weakness, but it is follow through, and that will decrease the number of sellers on the 60 close. And then 70 looks like the bulls are giving up. Looks like the bears are giving up. A little bit of a surprise bar on 61. It's possible climactic bar, but to me, it looks like a breakout, and it looks like we're probably going to go above the 34 high. And then 62, follow through. So now we have consecutive trend bars. Possible measured move from the open of 61, close of 62. We also may get a measured move from the low of 54 to the high of 61, projecting up to here, which obviously we did. Bad follow through 63, a bear bar, but we have not had a bear bar since 58. So obviously this is a sign of a strong breakout, and the bears have not triggered a bar. We have not gone below a bar since bar 52. So this is a strong breakout and will probably lead to higher prices. 64, bull bar, high one buy above 63, but it's probably still by the close and going higher. For the bears, they want a large two-legged pullback, rally, pullback, second leg up. Now, I want to say one thing before I forget. We may be trying to form we are trying to form a major trend reversal. We had a bull trend yesterday in the open today, strong sell-off, and we're retesting the highs. So the market's deciding, are there more buyers up here or sellers? As everybody knows, major trend reversals typically lead to trading ranges, which means most major trend reversals are really minor. They're not major reversals at all. 64, it's still by the close, but you have a bear bar, and that bar is warning you that the market's probably going to go sideways soon. 65, a tail. Remember what I said about doji bars. We had this doji bar here on 19, and what did I say when the market went below it? I said that we'll probably have to retest it. Well, we have a trading range bar here. We're probably going higher, but we're probably going to retest here. So that is why you have bulls buying and scalping out. If I'm a bull and I'm long and I see 63 and I know we're going to retest 63, why would I hold long if the market goes straight up? Why wouldn't I just get out and take a profit and then enter at the same price when on the retest? And that is why if we pulled back, traders will do that. But instead it didn't do that. 65 doji, and then 66 a bull bar, an inside bar, and then 67 a big tail. So it's becoming climactic. So we have a tail here on 65. We have an inside bar on 66. And then we have a breakout and a pullback. So it's basically three pushes up: 62, 65, and 67. So it's a parabolic wedge, but it's a minor wedge. Minor wedge means maybe a two-legged pullback lasting a few bars. And that's why a lot of traders, they will buy a small position just in case it keeps going up and try and buy more on a pullback. And then we have a bear bar, 68, and then a doji. We pretty much rallied into close. So fairly strong rally into the close. Another obvious target, 12 low. It was reasonable to buy the 12 low. And, the reality is 14 should not have happened. I mean, if you really think about it, we have a tight channel and then a doji. Probably buyers below, scaling in lower in a second leg. And instead we get this. This bar trapped all the bulls that bought the 12 low or the 11 close. It was reasonable to buy the 11 close as well. And because of that, there's going to be resistance at that price level when the market retests it. Same thing with bar 11. Bar 11, look what happened. We rallied, basically touched the close of bar 11, and then immediately sold off. And we went one tick above it. Very common to see that happen in trading range days. For always in, I think always in is the single most important method to trade. I think it's the single best way to trade. Breakout follow through on 1 and 2, always in long, reasonable to exit shorts below 5. And if you do, you probably buy again above 9 here. And then I'd get out of shorts below this bar, maybe a point or two below the bar. Certainly by the close of this bar, always in short, 14, sell the close. And then you get out above 22, aggressive bulls buy. And, if you don't get out here, I'd get out below 41. And not really great way to buy, not really a great buy above 44, middle of a tight trading range. And, if you do, the problem with always in a tight trading range is you're trading stop entries and you're going to get stopped out. So if you buy above 44, you're going to get out, maybe you get out below 48. And, again, it's just really easy to get chewed up. Second leg down, bulls buy above 54. And it's basically a buy the close rally until the end of the day. And go ahead and ask questions, and I will take a look at the comments here in just a few. So for stop entries, probably, the best stop entry, probably selling below 14, but big risk, hard to do. And other than that, I thought the single best stop entry was 54. It's a double bottom, higher low, major trend reversal. So we have a bear trend, trend line break, and then a double bottom. And it's basically trend resumption from the trend from the past few days. You can buy above 2, but fairly difficult. If you do buy above 2, I'd get out below 3, and it didn't trigger. Limit orders, probably sellers above 6, but strong trend, hard to do that. And then sellers above 12, buyers below any of these bars, 26, probably sellers, somewhere up here, but hard to sell. And then buyers on the way down. So traders buying near the open of the day, 28 low, 27 low. Sellers above 49, betting on a second leg down from 48, and then buy below any of these lows here. Buy the close, sell the close, buy the close too, but difficult to manage. Like I said, with 3, same thing with 4, difficult to manage. If you're buying that, what do you do below 5? And if you don't get out below 5, you get out at least if 5 or 6 is 2 bear bars closing on their lows. Buy the close in here, but very dangerous to buy. I would wait for a test of the moving average. Sell the close 14, 15, 16, 17, 18. You can even sell the close in 19, but I would not at this point. Like I said, doji will probably retest the doji. Buy the close 30, 31, but you're getting into resistance, the March high, and there's trapped bears down here that sold. And the bears that sold the 20 or 21 close are going to sell higher. So you don't want to buy necessarily too high. And probably buy the close 60, 61, 62, and even till, up here, depending on how aggressive you are. Let me take a look at questions. I'm going to go from first comments all the way down and just scan through them. Was shorting below 27, 41, and 48 reasonable for a scalp? Was shorting below 27, 41? Well, let's just start with each one. I would not sell below 27. I get the logic. It's 2 legs up, and you expect a second leg down after this sell-off to 21. But my problem is it's a tight rally, and the bulls may get a second leg up. So if you do sell below 27, you have a couple ways to manage it. You exit above 26, or you exit when the market becomes clearly always in long. Both are fairly difficult. If you sell below 27 and use a wide stop, maybe above 16, you really need to be able to scale in higher, such as up here. And you can see that's what traders did. Traders sold below 27 and more up here, and they got out during the 43 low. 41, what about shorting 41 or 48? 41's reasonable because you're probably going to test back in this area. So yes, I think that's reasonable. And if you do, I would get out very quickly after 43. 43 tells me the market sold off and rallied, so there's buyers in what could be a trading range. And for me, I don't want to sell low unless we're in a strong breakout like this, 16, 17, 18. I'm willing to sell low when the market is trending fairly strong. But otherwise, I'm nervous and I want to buy low and sell high. 48, it's reasonable to sell 48, but you're in a trading range. And it's what I talked about. The pullback could be above 48. So if I'm selling the 48, I'm anticipating bad follow through and scaling in higher for a second leg down. Possible trapped bears on the 21 close. Yeah, I agree with that. So it's reasonable to sell and sell more higher. That means that these shorts are reasonable, but the management is not that easy. How do you swing trade? I trade a lot of always in if I'm swing trading, and I explain that in this video. $12 to 13, trend reversal at the is 12 to 13 a trend reversal at the end of a climactic move? Yes. 13, you can see that on 14. We had consecutive buy climaxes late in the day, and then 14 was a strong reversal. Why do the bulls give up after a candle, after a bar like 13 here, but not after a bar like 6 here? The context is different. How do we recognize it live on a chart? Well, the first thing you have to do is understand its consecutive reversal attempts. 1 and 2 were bull bars, and then 3 is a reversal. But the problem is, if you sell below 3, you're selling the first reversal attempt of the day, and it's probably not. It might work, but it's probably not going to work. 5 is the second reversal attempt. It's going to have a higher probability than 3. 13 is going to be a higher probability of reversal than 5. Why is that? Well, you're going to have bears who sell below 3, sell below 5, and sell more below 12. Some of them just keep scaling in higher. And eventually, one of them is going to work. Now, on a day like yesterday, traders that fade breakouts and keep scaling in get killed. Hey, Brad, after the 21 low of day here, would a limit order short at a 50% pullback in today's range have been reasonable? I had one set that didn't get filled for me around bars 34 or 35. Yeah, I get the logic of that. My only problem with there's a few problems. For me, I wanted to sell a second leg, but as often what happens on days like today, it's basically consecutive sell climaxes. And you have a trading range day. You have a big rally, big sell off. There's bulls that bought up here and they're trapped and they're scaling in lower. There's bears that'll sell down here, probably going to get trapped soon and they'll scale in higher. And that's what creates sideways trading. And the problem with that is the pullback can be much deeper than you want. So for me, I typically do not set, limit orders and just hold them. I'll wait to see the formation. I'm not selling below here because I expect a second leg. This is getting pretty tight, so I expect the first reversal down to fail. If the market can go sideways long enough, I'll start consider shorting. Maybe here, sell below. But even then, if this bar reversed up, it may fail. And that's why some traders waited for 42. Because if 42 was a big bull bar, it would trap the bears and we could rally pretty quick. But it was a bear bar, and that's why we got this. So that's how I more or less look at it is, where if I'm a bull, where would I exit longs? I bought in here, but when I saw 35, I basically got out for, a couple points profit, maybe 1 point or a few ticks because I don't want to buy high in a trading range. I'm willing to buy high in a small pullback trend. The 35 confirms we're not in a small pullback trend. We're in a trading range. Where would you put a stop after entering on bar 12? Well, if I wouldn't buy the low of 12 because again, I want to buy closer to the moving average. And what I said in the blog post in the morning, I mentioned 2 hours of trading range trading. If I think the market's going to be in a trading range, I'm going to trade it like a trading range. And after 2 or 3 legs up, I'm looking to sell. After 2 or 3 legs down, I'm looking to buy. But for me, I did not short. I shorted on the way down. This bar was getting to be big, so I just sold. I just hit sell the market, used a wide stop, and said if it pulls back, I'll just scale in. And I don't know. I think maybe I added on 15. I may not have it all, but it just got short and just basically held. Was buying above 64 reasonable? Yeah, you could buy 64, but you need a wide stop, probably down here, and better if you can scale in. If buying 54, where would the stop be? That's tricky. Some traders they'll buy above 54, but a stop below 54. There's logic to that. The market's tried twice. If it breaks below, we could test all the way down to here. Other traders buy above 54 and put a stop below 22. But even if we fall below 22, we'll probably find buyers. Most traders should either buy a bar, put their stop below the signal bar, or wait for a breakout like 61 and then put their stop below a bar like 59. All right, so it'll be interesting tomorrow. Probably going to get a bear close, and we're probably going to see profit taking going into tomorrow. All right, hope everyone has a good rest of their evening.